Hello guys, my name is Marcus Mia. Welcome to my YouTube channel. The S&P 500 is one of my favorite and the best investment any investor can make in the stock market, providing both diversification to over 500 of the largest US companies, a history of long-term dependable returns, and can be used by anyone to passively invest for retirement. Now, if I invested just $300 a month or $10 per day for the next 40 years into something like Vanguard's VOO, which is an ETF that tracks the S&P 500, I have over $1.5 million due to the power of compound interest. I think I found a combination of two ETFs that can not only outperform the S&P 500, but at least keep in track in line with it and have a higher dividend yield so you can get paid some sweet passive income in the form of dividends. Now the result is combining both SCHD, or Charles Schwab's US Dividend Equity ETF, and SCHG, which is Charles Schwab's Large Cap Growth ETF. Now with SCHD and SCHG, we can capture the highest highs of the stock market, but also weather some volatility when the stock market inevitably pulls back and get paid a dividend of over 2%. Now SCHG will serve in our two-fund portfolio as our growth category. By growth, we mean stocks that have the potential of above average returns than the stock market. Now, there are other ETFs that can replace or do the same thing as SCHG, such as VUG, VGT, and QQQM. Now, these all can serve the same purpose as SCHG. However, before you guys buy some of these ETFs, make sure that they don't have any fund overlap of above around 65%, I'd say. For example, SCHG and VUG do have a fund overlap of 80%, so you should not buy them together. Always check fund overlap. Now, the reason why I chose SCHG is because the S&P 500's performance is mostly driven by the performance of the largest companies, mostly in the tech sector. Now, SCHG is a growth ETF with its highest holding being in technology. The end result is SCHG's basket of 245 companies with potential for future growth and high returns to you as an investor in the future. So not only can SCHG take our returns to the moon, it can also have some downsides like more risk and more volatility than something like VOO. SCHG has appreciated over 14.37% on average year over year over the past 10 years, beating out VOO, which has done 12.16% on average every year. Now, the reason for these amazing returns that have outperformed the S&P 500 or VOO with SCHG is because of its highest holding into the technology sector, which is typically known as a growth sector, of almost a 50% allocation into SCHG, and it has some of the best companies with growth properties such as Apple, Microsoft, Amazon, Nvidia, and Google. Now, to complement SCHG in our two-fund portfolio, we will add a dividend category, which will be SCHD or Charles Schwab's US Dividend Equity ETF. Now, there are other ETFs that can mimic or replace SCHD, such as VYM and DGRO. The reason why I included SCHD is because if we only have SCHG, we are missing out on the potential of high dividend income in the future, and SCHD can keep our two-fund portfolio stable because typically dividend ETFs are going to be less risky than growth ETFs and thus having less volatility in market downturns. SCHD's dividend yield is 3.79%, which is over double the dividend yield of VOO, while having great performance of over 11.67% appreciation on average year over year for the past 10 years. SCHD's top sector holdings include industrials, healthcare, and financials. Now, some of the companies included in SCHD's holdings are companies that provide constant stream of cash flow that are predictable and stable, thus earning us as investors with high dividend payments and passive income from some of the best companies such as Broadcom, Merck, Pepsi, Coca-Cola, and Home Depot. Now, both SCHD and SCHG have a history of outperforming the S&P 500 or VOO due to SCHD's high dividend payments and capital appreciation, and SCHG's growth property that has rocketed over the past 10 years. Now you can invest in VOO or VTI, which is an alternative to VOO, completely alone, and in the next 40 years, you will have a huge nest egg that you could pull out money from and retire off of very comfortably and easily. However, you can miss the potential of higher returns from something like a growth ETF like SCHG and some passive income in the form of dividends from a dividend ETF like SCHD. Now, if we had $300 a month to invest and split up that money with $150 a month into SCHD, in the next 40 years, at the rate of return that SCHD provides, including its dividend, we would end up with over $1.2 million at the end of investing in SCHD. And if we split the other $150 a month and invested it into SCHG at that same rate, we would end up with, in 40 years, over $2.4 million. Now, we would end up having over $2 million if we ended up investing in the combination two-fund portfolio of SCHD and SCHG than if we fully went in 100% on VOO. And on top of that, we would have a higher dividend yield, since the dividend yield of VOO alone is 1.57%, but the 50-50 split between SCHG and SCHD will yield us a higher dividend yield of 2.11%. If we invested in VOO alone, then our dividends would be $1.5 million times 1.57%, which will come out to over $25,000 in annual dividends, or just over $2,000 a month in monthly dividends. But with SCHG and SCHD combination, our annual dividends would be $3.6 million times the dividend yield of 2.11%, which will come out to over $76,000 a year in annual dividends, or just over $6,350 a month in dividends. Now, past results are an indication of future returns. Always do your own research before you buy any ETFs. Don't just blindly copy these. I guess the disclaimer is I do own VOO as my highest holding, and a small portion of it is to SCHD and SCHG to mitigate some risk. This is all for entertainment purposes only. I hope you guys enjoyed this video. If you guys did, please leave a like because this cute puppy did. And comment down below an ETF or a dividend ETF or a growth one that you are buying and holding forever. Now, hope you guys have an amazing day. Continue to crush in the stock market, and please have a good one.